Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, number 54, all about life insurances. There's my disclaimer, facts and figures, information only, it is not advice. Yeah, we was talking about general and house insurances in previous sessions, and this one's now getting onto the business of insuring ourselves. And as an advisor in previous years, I've certainly seen the situation where I believe probably 80%, this as a rough guide, the people I see would be totally underinsured as far as their needs is concerned for life cover and death cover and so forth. People, it's one of those things that I ask clients, how much insurance have you got? Very few people can actually turn around and say, yes, I have 385,000 or whatever it may be. So it's always a case of making sure you have enough, obviously, but really the tough part is to keep on reviewing this at regular intervals to see is it still appropriate. Because the older we get, then generally speaking, the need for our insurance decreases. We've got more money, our debts have gone down. Hopefully, the kids may have moved out, but basically our need for, and as we get closer to retirement, our need for such large amounts for life cover diminish. But of course, if we're in our 30s and we've got 3 kids and we've got kids at school and private school and big mortgage, then obviously we need more insurance. So it's always a case of sitting down if you've got a partner with your partner to sit down and go, okay, what would our situation be if I died, if your partner died, if I got permanently ill, if my partner got permanently ill, and so forth. So you can actually look at the scenario, what would happen, what money would be available, what debts would have to be paid out, and so forth, to really understand your situation. And so it can indeed be a complicated thing to do. And I've got there, consider using a calculator. I'm going to talk about that in the last slide, so we'll come back to that. But it really does come down to understanding your needs, what you really would happen, what would happen. Is it going to expose you to some sort of financial difficulty? And as I say, the bulk of my clients, I'd have to say, yes, it would. It would indeed. How much is indeed needed? Now, of course, it comes down to you don't want your partner to be better off if you're dead, that's for sure. You might have wanted to check your Weet-Bix in the morning if that was the case. But it is a case that you certainly need to ensure that they are not going to be put into a situation where they've got to, have to sell the home or they're going to lose their home. It's not a case that they're going to be eating bread and butter forever. It's a case that they should be at least be able to maintain the same quality of life. That's what we're aiming for. And it is a case that don't just consider yourself, do it both directions. Even if your partner's earning less money, it could mean that, yes, you still need to have a reasonable amount of cover for them, literally, because even though they might be only bringing in a smaller amount of money, it may be a case that because if they're not around, then you've got extra costs in regard to things like childcare. And not being able to work as much because you are indeed looking after children or something like that. With insurances, then it comes down to the fact that with most insurance companies, they'll offer you what's called stepped or level premiums. Now, what this means is that if you've got a stepped premium, this is probably the most common one, where you take on some life cover. And life cover, basically, younger is cheap. So while you're sort of, in your 20s, having life cover is pretty cheap. But as we get older, of course, the expectation, getting closer to death, that this then becomes more and more expensive. So as you get older, your premiums are going up and up and up and up and up to get to the point where eventually you go, gosh, I can't afford this, and you cancel insurance when probably it's more likely you're going to need it. Having said that, as I said earlier, as we get older, we don't need as much insurance, so you can cut back on your insurance, which obviously will cut down on the premium. So as you get older, you can keep an eye on it And whereas you might have had, $1.5 million worth of death cover, you drop that down to $1 million, and then you drop it down to 800 and drop it down to 500, and so it goes on as your needs then change. Whereas a level premium basically means that you've decided you need $800,000 worth of life cover, or whatever your number is. Your premium is set, and then every year your premium remains the same. Now, you might have a CPI increase on that level amount that you've asked for, and effectively your premium might just go up with like a CPI adjustment because you're getting a slight increase to take into account inflation. But in theory, your premiums remain constant. Now, under that scenario, if you were a younger person, your level premiums would be more expensive when you're in your 20s than the step premium. But because it's level, it stays at that level. And so when you're getting into your 40s and 50s, your premiums for your life cover are a lot cheaper than someone who's got a step premium. The crossover, generally speaking, is about 7 years. So if you're planning to have your life cover for more than 7 years, then generally speaking at 7 years, you are now in front by basically having level premiums, meaning you're paying a bit more earlier, but then of course later on your premiums are cheaper in comparison to the step premium. So you've got that ability to do that. And of course, what is death cover? Yep, it literally means that if you die, a lump of money will indeed go to your estate or your beneficiary. You can nominate who the money indeed goes to. Now, as time and things change, you may indeed need more cover. And all of a sudden you got married, all of a sudden now you've got a dependent, you've got an extra child. Every time something major happens, you need to reconsider the amount of insurance that you do need. And if you do need more insurance, then generally speaking what you can do is go to the insurance company, tell them what's happened, this major event, and they will indeed increase your insurance level up by a certain amount without getting you to fill out a medical questionnaire, because there's a reasonable reason, there's a reason here why you want the more cover. It's to be expected that you want more insurance if all of a sudden you've just had twins, and so it goes on. So they will increase your insurance with no underwriting, no requirement for doing a medical questionnaire based on some sort of life event. Whereas if you just decide, even now, if you just reviewed your insurance and say, gosh, I'm way underinsured, yes, you'll have to fill out a medical questionnaire, because the insurance company is going to say, what are these people all of a sudden want more insurance? What's wrong with them? So if you are increasing it, you'll need to fill out a medical questionnaire. If you're decreasing it, generally speaking, you just need to put it in writing to decrease it there. But I say, it is a case of reviewing this on a regular basis to make sure that the level of your insurance is appropriate for you and your family. Now, you can indeed get insurance inside super, or you could just trot along to AMP or ANZ or whoever it may be, one of the insurance companies, to get insurance outside of super. And so there are 4 different types of insurance. I'm going to talk about income protection, that IP, and trauma insurance in later sessions. This session we're just talking about death and TPD. TPD is literally totally permanently disabled, and that means you've been hit by a bus, you'll never work again, and effectively the money will pay out to you to assist you with obviously medical costs and or literally revamping your house for wheelchair access or whatever it may be, helping you with the costs and expenditure of your disablement there. But you can indeed get it through super, or you can just go to an insurance company. There are pros and cons of both. The best part about getting it through your super is that you don't have to pay for the premiums out of your back pocket. It literally means that if you say, oh my gosh, I need to increase my insurances, but I can't afford to do it, by doing it through your insurance company, through your super fund, the premiums are deducted from your super account. Therefore, you don't have to find the money out of your back pocket every fortnight. Yes, it means your super's not growing as quickly, literally, because your premiums are being deducted from your account. But it could be an easier way to about afford to do it when things are a bit tight. Generally speaking, it's cheaper to get it through super because most of the insurance companies, most of the super funds aren't insurers. They just go out to tender and they go to an insurance company and say, we've got 100,000 members in our super fund, they need insurance. Therefore, the insurance company is pretty keen to get 100,000 new clients, and therefore they give discount to the super fund. And with most of these industry-style super funds, they then just pass on that discount to the member, so you basically get it at a cheaper rate. So that can be usually quite good. And providing that your employer pays into your super fund, generally speaking, they will offer you certain levels of insurance with no medical. So even if you had a pre-existing condition, it could be a case that you can get a certain level of cover without having to fill out a medical questionnaire, literally because your employer is just paying into your super fund. So that can be quite helpful for people with some sort of medical issues there. If you ever want to increase it, of course, then yes, you'd have to do a medical questionnaire. But each super fund is different as to the level of cover and what they do offer you automatically and what's required under certain circumstances. So just shop around, check out what your super fund will do as well. There are some issues, however, in having insurances inside super. Death cover, not so much, because if you're dead, you're dead. The money is paid, obviously. TPD can be a little bit difficult, where with TPD, you've been assessed for a total permanent disability. The insurance company pays out, but of course it's inside a super fund, the money gets paid out to the super fund, and then the super fund's got to go through the exercise to prove that you are indeed totally permanently disabled to access the money. Now, that's not as bad as it used to be, because a lot of the insurance companies and super funds are saying if the insurance company says you're TPD, so will the super fund. So it's not as bad as it used to be. There used to be problems in that regard. We'll talk about tax and so forth when we talk about income protection, because there is no tax deductions for death and TPD outside of super. So it doesn't really matter whether you've got death and TPD cover inside or outside of super. There really is no tax deductions available. Having said that, if you were to want to pay the equivalent amount of money, so let's imagine your premiums are going, oh yeah, well, I've got $2,000 worth of insurance premiums now inside my super. This is eating into my super. So therefore, don't want my super to go backwards. I will pay I'll make a contribution to my super fund to cover the insurance premiums. If you did that as salary sacrifice, you would indeed get a tax deduction for paying for your death and TPD cover. So it's not like you're just paying the premiums. It just means you're putting money into the super fund, which is then used to pay pay for your insurances. So you just got to think about what are you trying to achieve there. Most insurances inside super funds for death and TPD will often finish at the age of 65, whereas if you've got super funds insurances outside of super, you could have death cover at age 95. It could be quite expensive though at that age, as well as you can well imagine. So a few pros and cons. You need to understand the differences before you jump on board either way there. But it is always a case of doing a comparison. What would it cost you to get the insurance outside? What would it cost you to get the insurance inside? What are the ramifications of doing either? Most of the super funds, if you're getting insurance inside super fund, will give you what they call an age-based premium, meaning that the level of cover varies as you are at different age, but your premium remains the same. So here's an example. I just took a snapshot from one of the super funds here. If you joined at 21, for instance, they gave you $150,000 worth of death cover, that's the dark blue line, and they gave you $75,000 worth of TPD, that's the sort of light blue aqua colour there, and you got that automatically. That's their automatic cover at 21, because obviously theoretically you don't have a lot of expenses, you don't really need a lot of cover, And of course, some younger people living at home don't need any insurance. You can see there that if you, however, got your insurance at 35, then all of a sudden we've now got closer to $325,000 worth of death cover, and half of that for a TPD, because obviously, in theory, in your 30s, you've got more, expenses, debt, children, mortgages, and so forth, and so you need a high level of cover. And this is automatic. So basically, what's going on here is your cover is changing, but your premium is pretty much staying the same. But as you get older, once you get to 45, your insurance cover, you're still paying the same amount of money, but your insurance cover falls off a cliff because you're now getting older and more risky to the insurance company. You get up to my age, and you can see there you've got around about $7,000 worth of death cover, just enough to dig you out or put you in, and that's about it. And you've got to ask the question, why would you pay the premium to get such a low, return on your money? So if this is a case of, yep, it in theory could be appropriate, but for many people, things aren't normal, and you still may have large debt at 58. You still might have kids at home and younger kids because you've started later, and so it goes on, in which case you don't want your insurance to fall off a cliff. So you can then apply for fixed cover. And the fixed cover is that, like that fine red line there. You can ask for whatever level of cover you like. And most insurance companies will allow you to go up to around about $50 million worth of life cover. That would be expensive. But you could choose your life cover. It will stay at that level for as long as you want it to stay at that level. But of course, as you get older, the premium will get more and more and more and more expensive. So find out what you've got. Find out what type of insurance you've got. Find out what's going to happen as you get older and work out, is that indeed appropriate? It's amazing the number of people who don't know what insurances they've actually got. If you do have two lots of death cover, so you've got insurance outside and inside of super, or two super funds, you've got two lots of death cover, yes, both will pay. So if you had 200 with Australian Super, 200 with AMP, yes, if you died, 400 would go to your beneficiaries. That's not the case when we talk about income protection in a later session. So, I mentioned about using an insurance calculator. Most of your super funds will indeed provide you with an insurance calculator, but because they're run by companies the insurance companies are trying to make money, I find a lot of those calculators can be a little bit excessive. I like this one. This is on the Money Smart website, moneysmart.gov.au, and literally they've got a life insurance calculator there. And the idea is that you can punch in you, your family, are you single, your partner, how many kids have you got, how old are your kids, and so forth. And then you go down through listing all of your assets, what's your, what is, how much money you got in the bank, how much money you got in super, and all of your debts. So how big's your mortgage and how many credit card debts and all that sort of stuff. It will then come back and at the end of it, it'll spit out exactly how much insurance you need. Now, I guarantee that a lot of you will have a heart attack when you see the difference in what you've got compared to what you really should be having. But please, have a look at this thing now. Of course, what they're offering is premium. You may decide, look, no, because of other circumstances, you believe that you could sell one of your investment properties, or you could sell your own house and downsize. Your parents would help you. You've got a very good relative or sibling that would help you. Whatever the case may be, there may be some extenuating circumstances there where you say, okay, if I really did get into a pickle, there's plan B. But I never liked plan B's in the regard that things could change. So please have a look at the calculator, use it, see what the story is. And if you ever want to discuss it more to understand how it all works, please just make a booking with us and we'll guide you through it. Look forward to talking to you again next time.